Hi, I'm Calvin Rose, and welcome to Invest Smarter. You guys voted for your favorite Vanguard funds and ETFs. Let's see how the poll turned out. A little over a week ago, I published a poll on the Friends of Vanguard Facebook page, which I'm a member of, asking which are your favorite Vanguard funds or ETFs. Now, I put a few of them up there, but I left it open for others to add funds and ETFs to it. Let's take a look at that poll. So you can see the poll here. I published it on June 4th, just about 10 o'clock in the morning. And you can see, I think I put these first three up here. I only put three funds up here because these are the three that I think get talked about the most on this website. But you can see some of the other members added quite a few other funds here. Let's see if we can, it's quite a list here. But anyway, so that's the poll. And let me show you a spreadsheet where I took the results of this poll and put it in a little different form so we can see how the voting turned out. So here you can see the list of funds, and I've ordered them by the percentage of votes that they each got. So you can see the top voted fund was the Vanguard Total Stock Market Index Fund, and I've combined the mutual fund and the ETF into the same count here. Same with the Vanguard 500 Index Fund. I've included the mutual fund and the ETF, and you can see what that looks like. No surprise here that Wellington came in third, and then it goes down from there. So let's take a look at each of these funds and how they've performed over a previous 15-year period. And why am I going back 15 years? Well, because you want to include a time frame like 2008, 2009. You want to include the pandemic. So you want to include some bad times in there. It would be ideal if I could show you these funds going back to, let's say, the 1990s, but most of these haven't existed that long. In fact, a lot of these only came into being in 2004. So I think going back to 2006 is pretty representative. So let's take a look at that. So now let's take a look at each one of those funds and ETFs and see how it performed over a 15-year period. Now, why am I using a 15-year period? Well, it's really important to make sure that you include a really bad time like the big financial crisis in 2007 to 2009 or the pandemic. Ideally, I'd love to be able to show you these funds and how they performed going back into the 1990s, but many of these funds only came into being in 2004. So we're going to go back to 2006. We'll follow a 16-year period, and I'll show you how they've performed. Now let's take a look at how that might look on a chart. Now, for those of you that have seen my previous videos, you're probably familiar with this chart, but for those of you who haven't, what you're looking at here is this y-axis is compound annual rate of return. And then this x-axis here is the amount of maximum loss you would have incurred in your portfolio at some point in that 15-year period. So for the S&P 500, for example, let's look at the S&P 500 Total Return Index. You can see this index had a 10.51% compound annual growth rate, but it also had a 55% maximum loss. When did that occur? Well, obviously that occurred in 2008 to 2009. Back in the pandemic, it fell 34%. So it had a couple of big losses in that time period. So basically, if you're looking at this graph, anything out here in the sort of reddish colors is bad, and anything up here to the left, up and to the left in sort of the blue area is good, right? Because you've got more return up here, up and to the left, less loss, less maximum loss. So this is a better place to be. Obviously, we'd all like to be at 20% returns with no loss, but that's just not realistic. Let's now look at how some of these funds have performed, and we'll look at the sort of more pure equity plays first, and then we'll look at some of the dividend and income plays second. What's also interesting about this poll that I did is nobody added any pure fixed income funds into the mix. I guess I'm not surprised. People don't care about that too much. They're more in love with getting big returns. So you won't see any of those here. You'll see some funds that use bonds as a component of their mix, but you won't see any pure, for example, U.S. government treasury funds or aggregate bond index funds. So let's go down the list in order of popularity. So the first one on the list was the Vanguard Total Stock Market Index Fund. VTSAX is the mutual fund and VTI is the ETF. So let's put that on here. And you can you can see here, I'm going to have to move this so you can actually see it. You can see that this fell right on top of the index, at least from this perspective. It performed just about as well. If actually it performed a little bit more return, a little bit more return, a little bit more loss than the S&P 500 index, total return index. But now this total index, this total stock market fund isn't trying to mimic the index. It is trying to give you a broad exposure to the stock market. So its stated goal is not to just match the S&P 500, but that's in fact pretty much what it did. So now let's take a look at the Vanguard 500 Index Fund, which is trying to match the S&P 500, and let's see how that performed. right on top of it. It really nailed it. Did a great job of matching the index. Now, let's look at the World Stock Fund, which again is more of a pure stock fund. Let's see how that did. That didn't perform as well as the S&P 500. You would think if common wisdom played out, diversifying your holdings further and going into more international and across the world, you do better. Actually, you did worse here. Worse in terms of return and worse in terms of maximum loss. So while the S&P 500 had a 10.5% return, 55% loss, this total world stock fund, VTWAX or the ETF VT, had only a 6.76% return and almost a 59% maximum loss. So that doesn't look very good. So here's the Vanguard Information Tech Fund, VGT. Now this looks really good. Here you've got much more return than VOO, the Vanguard 500 Index Fund, or the Total Stock Market Fund. You've got much more return. You're at 16.35% over that 15-year period with a 54.6, almost 55. The maximum loss is basically in the ballpark, but much more return here. Interesting. Now, somebody in the poll threw in the Vanguard Energy Index Fund, VDE, and I was really kind of surprised when I took a look at this. Let's put it up here. You can see not only is the return paltry, 2% return, you could do better in fixed income, but the maximum loss is almost 75%. Now, I asked myself, okay, well, this fund is trying to mimic an energy index. So let's compare it to the energy index to see how that did. So I was kind of surprised to see the Vanguard Energy Index Fund have such poor performance. But when I compared it to the energy index, it really was in the right ballpark. Energy overall, over a long period, 15 years, has had some huge up years, 60% returns, followed by some awful years. So not a great place to be over the long term, which was kind of surprising to me. Now for this next fund, the Vanguard Prime Cap Core Fund, I had to move the label for the Vanguard 500 Index Fund below here. So when I put this new fund in, you'll be able to see it. This fund really kind of surprised me. The Vanguard Prime Cap Core Fund actually does a better job than the 500 Index Fund, both in terms of return and in terms of maximum loss. This looks like a really well-run fund. The maximum loss was 47%, so quite a bit less than the 55% loss we saw here. And the return was somewhat higher at 11.3%. So this is a well-run fund and looks like a very good fund to have in your portfolio. Now let's take a look at the Vanguard Growth Index Fund, VIGAX for the mutual fund and VUG for the ETF. Interesting. So that lived up to its name, Vanguard Growth Index. It is growing better than the S&P 500. But what's surprising about it is it also has a better loss characteristic. So this is even better than the Vanguard Prime Core Fund with a 13.38% return and better loss characteristics at roughly minus 51%. So you look, whether it's minus 51 or minus 55, that's a lot of loss. So, but if you're going to get that much loss, you may as well get some more return. Now that we've taken a look at the more pure equity funds and ETFs, let's take a look at the funds that were voted on that include growth and dividend income generation and see how those compare. So I'm not going to leave them all up here because this graph was already pretty messy. But so what I have left up here is the S&P 500 Total Return Index just as a reference point. But so the first one, the highest ranked one on our list was obviously Vanguard Wellington Fund. So let's see how that did. And again, we're not looking for it to match the S&P 500 Total Return Index because this is also trying to generate income as well as some equity exposure. And this one does have fixed income instruments in it. So as you would expect, you're getting much better maximum loss characteristics here with the Wellington Fund, but you're also getting less return. So instead of the 10.5% return we're seeing here in the S&P 500 over this 15-year period, you would have seen about 8.6, 8.7% return with a 36% maximum loss, which is a lot easier to stomach. Now let's look at the Vanguard Dividend Appreciation ETF, VIG. I love the symbol, VIG, VIG, get a VIG. So interesting. Now this one, Vanguard Dividend Appreciation Fund, performed just about the same as the S&P 500 Total Return Index. Slightly less return, maybe a 0.5% less return, but more interestingly, a 0.5% more maximum loss. I'm not a fan of that. So let's see what else we've got here. The Vanguard Growth and Income Fund, VQNPX. This one looks like it's falling just about in line with the Vanguard Dividend Appreciation, VIG Fund. And I'm sorry that the label's kind of mushed in here, but you can see this green bubble here. It's just same return, a little bit more return, a little bit more loss. So not sure what the advantage of that is. Now let's look at the Vanguard Equity Income Fund, VEIRX. Again, mutual fund. Oh boy, these labels are really getting out of hand here. So here's the Vanguard Equity Income Fund. You're getting less return than the S&P 500, but you're also getting a little bit less maximum loss, not much. So you're getting about a 1.5% less return than the S&P 500 with dividends, and you're getting about a 1.5% better maximum loss. So kind of an even trade-off there. Now let's look at the Windsor 2 Fund. Let's see what that looks like. A little bit hard to see here, but this blood red bubble is the Vanguard Windsor 2 Fund. It looks like it's trying to invest in dividend-paying equities. More loss, which is surprising with dividend, with a lean toward dividend-paying stocks. So a little more loss than the S&P 500, but also a substantially less return. This is not a good look, in my opinion. So let's review where we're at. We just took a look at the typical income and growth funds, and you can see from this chart that most of them really, I don't think, add much value here, except for the Vanguard Wellington Fund, which indicates why it's probably so popular. It is the better of this group. And then let's review the pure equity funds and where they sort of landed. This is a more cleaned up version of that chart where the labels aren't so jumbled together. But you can see, well, you can't see where the total return index is, the S&P 500 total return index, because it's covered up by Vanguard Total Stock Market, and it's covered up by the Vanguard 500 index. So these two funds here have done a great job of performing about the same as the S&P 500. The Vanguard Prime Cap Core, I think it does a wonderful job. You're getting less maximum loss, better maximum loss characteristics, and more return. That's a good thing. Clearly, Vanguard Information Tech does a fabulous job, knocks it out of the park in terms of return with about the same loss as the S&P 500. I think that the Vanguard Total World Stock Index doesn't do nearly as good of a job. I think you're reaching for more diversification, and as a result, you're getting hurt, both in terms of return and maximum loss. And then finally, the energy index is something I would think you shouldn't have in your portfolio in an ongoing basis, given this performance. And it's not Vanguard's fault. The energy index just has not performed well over long periods of time. So this is something you might want to throw in when there's a world crisis like there is today, take advantage of the big up move and then get out of it. But I don't know how you really time that. I'm Calvin Rose, and thank you for watching this special edition of Invest Smarter, where we reviewed various Vanguard mutual funds and ETFs and how they've performed relative to each other over a previous 15-year period. If you like this video, please hit the like, subscribe, and notification bell so you won't miss an upcoming episode. That's all for now.